Hello everyone, welcome back. This is an important update as we launch a brand new strategy and portfolio that I wanted to introduce to everybody here. This video is dedicated to introducing the Zacks Deep Value Portfolio. This is a new strategy that we have launched very recently, and I wanted to give you an introduction into the strategy and methodology of this approach. Ultimately, our goal here is to find attractive opportunities without the classic value trap, as they call it. Value strategies have been, a centerpiece of many investment strategies out there, but many strategies fall into a trap, is what we call value trap. We'll take a look at exactly what that is and how we intend to avoid that trap. So let's get started. So value investing, in a nutshell, has been something that investors have tried for decades and with very wide degrees of success or failure. Some have added significant value over time, as we know that the strategy has been popularized by Warren Buffett, Charlie Munger, and other very few but very great investors that have popularized this methodology. And ultimately, in a nutshell, one of the problems that those who try to replicate their success have had is the fact that great businesses rarely trade for a great price, right? Because why would that be the case? If a company is proven to be truly great, if they are a high quality company, and we can define quality in three general areas. One, a company that can compound over time, that's growth. A company that earns attractive returns on its capital, that's ROIC, and a company that generates substantial free cash flow. Those are the three broad pillars of what we call quality, right? These are quality companies and everybody wants to own them. However, companies that have these three characteristics rarely go on sale. They're usually not very expensive, and so therefore those that try to create a value-oriented approach to equity investing usually try to do it by focusing on the right side of this Venn diagram. Low PE, low price to free cash flow, low price to book. But the problem is that, great businesses rarely trade for a great price in terms of low PE or low free cash flow multiples. And awful businesses trade at a great price, but they rarely make good investments. You can own companies that trade at low multiples and, for the last decade plus, underperform the S&P by a vast margin. And so a lot of value-oriented, meaning, strategies that focus on low price multiples have underperformed massively versus the S&P 500 for 15 years now. So how can we target that cross-section, right? How can we target the cross-section between quality and attractive price? That is the key question here. And the answer is that by buying quality businesses who are currently experiencing a temporary or cyclical downturn, and therefore whose shares are trading at a deeply compressed multiple to normalized earnings. So a lot to unpack here. So this method, it requires two things to occur to be successful. One, the company has to successfully navigate through the rough patch that it's going through and return to revenue and earnings growth. And number two, it requires time and patience. So we know that value investing, means buying a business at a discount to intrinsic value. But the way that we measure these factors differ widely. So the way that we do it at Zacks is unique, and we believe it offers a superior approach than traditional PE or price to free cash flow multiples, which again are traditionally at the center of any value-oriented equity strategy. So again, most ETFs out there that use a value approach, like for example the S&P 500 value index, and the ETFs that are built on that, the Russell 1000 value ETF, these value ETFs, most of them use, in one sense or another, a price multiple to decide what companies to own. And usually it targets for a low PE or a bottom percentile of PE multiples out there, or price to book multiples is another popular one. However, the problem, again, with that approach is that when you look at low PE companies, they're usually companies that don't have growth, that aren't capital efficient, and have poor free cash flow conversion, or some combination of these three. So that's why value is typically different from quality. But ultimately, we want quality, right? We want to own high quality businesses, but we don't want to overpay for them either. So how do we get both? How can we get quality companies for an attractive price? That's the key question. And again, we have to do a couple of things here. Usually companies that are, expected to grow, companies that earn high returns on capital, and companies that convert those returns into free cash flow, they typically don't go on sale. They don't get hit, right? So when these companies, it's very clear to the market that they're growing at a high rate of efficiency and throwing off, very attractive levels of free cash flow, why should they ever go on sale? And the answer is the time to get them is when they go through a temporary downturn. So sometimes these great companies out here, high quality companies, do go through rough patches. Companies that go through a downturn for a year, maybe 2 years. In some cases, but rare cases, 3 years, because great companies usually don't go through a rough patch for longer than 3 years, just by our experience. So typically the time frame is 1 to 2 years. And when a downturn happens, when an earnings recession happens for greater than a year, shares get hit, right? And so that's when they go on sale. So if we can focus on a strategy where we target quality companies, meaning companies that do grow over time, companies that do earn high returns on capital, and companies that do have a track record of throwing off a high level of free cash flow, but are simply getting hit because they're going through some temporary downturn. Like, for example, a lot of companies who were high quality businesses but are also dependent on credit, for example, to generate a big portion of their sales, they have gotten hit hard from 2022 onwards. Why? Because that's around the time that the Fed started increasing interest rates, and that makes it very difficult for their customers to borrow money in order to purchase their products. So companies that are dependent on credit, they might be high quality companies, but their shares have gotten hit very hard these last 2 years because they're going through that temporary cyclical downturn. And so therefore those shares are trading at a very deeply compressed multiple to normalized earnings. And by normalized, we mean average earnings. So we don't look at earnings for any given year. Because the problem with that approach, as we'll see in future slides, is that PE multiples look at just 1 year, one specific year. But if that company is going through a temporary downturn, then earnings for that particular year might be artificially depressed. And when they're artificially depressed, it looks like they actually have a high PE multiple, even when the shares have gotten hit hard, because the earnings have been revised down. It looks as though the PE multiple is very high. And so, those that are focused on PE are then erroneously concluding that the stock is too expensive. And the answer to that is to do the exact opposite of that. And so that's why the Zacks approach is unique, because we believe that it offers a superior approach than the traditional PE, or price to free cash flow multiples, which are the center of any value-oriented equity strategy out there. So if you look at a direct comparison of the two approaches, the traditional value investing approach is to look for low PE companies, low price to free cash flow, low price to book, low enterprise value to EBITDA, low enterprise value to sales, right? However, we do something different. We're looking for a deep multiple compression, Not necessarily low in an absolute sense. We don't say, well, let's buy all stocks that are under a 15 PE. No, because that, ends up getting you that value trap that we said. That ends up getting you companies that don't have growth, companies that are, deeply cyclical without much compound growth involved, companies that don't earn attractive returns on capital. So what we look for is a deep multiple compression. That's the first distinction. Rather than a low multiple, we look for multiple compression, deep multiple compression. And that too to normalized earnings rather than any single year's worth of earnings. PE multiples look at a single year of earnings, whereas we look at normalized earnings. So this is important because this helps you normalize for temporary events that are depressing earnings for the time being. But with a little bit more qualitative work, a little bit more homework, a little bit more of an overlay, which is ROIC, we can have reasonable expectation, a reasonable probability that the company that is experiencing that downturn will eventually get back to growth again. And therefore, this dip is a dip to buy. However, if you're focused on PEs, you're not going to see it. You're not going to see the multiple compression. If you're focused on normalized earnings, you will see that compression. And we'll take an example here in a minute. So we want deep multiple compression to normalized earnings. We want a track record of consistently high ROIC. This is very important because companies that earn high returns on capital consistently over time, even if they're not doing it currently right now, because they're going through a difficult situation, which is, we believe, temporary. But if a company has had a track record of a consistently high ROIC, it means that they are doing something that is very difficult to replicate. Remember, if a company is highly profitable, meaning if they're earning very attractive returns on capital, then that attracts competition to come in. And whatever advantage that they had would then be competed away through price competition, and those margins get eroded over time. But if a company can do high ROIC for a long enough time period, there is a high level of confidence that we have that the company in question is doing something that is not easily replicable by competitors. This can happen when a company has a strong brand. This can happen when a company has an R&D expertise that's not easily done by others. This can happen if a company has network effects that are very difficult to append. This can happen if a company has, very large economies of scale, which is very difficult for the competition to enter. And there's a couple of other reasons why a company can have high ROIC, but they're all good reasons. They're all good reasons to go towards a company like that when they're going through a rough patch, because we know with reasonable confidence and probability that because they can do something that not many others can do, there is a reasonable probability that they can get through and navigate through this difficult situation that they're in right now and eventually get back to growth. And therefore, this compression, the multiple compression to normalized earnings, is a dip to be buying. Again, if you overlay both of these with a track record of long-term earnings growth, meaning even if earnings growth is negative for the last year or two, or even for this year, if in the long run, it is evident that the company is able to compound growth over time, that again adds to our conviction level. We also do a lot of qualitative work. We want to make sure that these are industry leaders, not followers or not companies that are being disrupted by better technology. So we do a lot of qualitative work on that. And again, consistently high free cash flow conversion, again, may not be the case currently because they're going through a difficult situation. But over time, we want to see evidence that the company can generate substantial levels of free cash flow, meaning they're able to convert a substantial portion of the net income that they report on the income statement into free cash flow. These are all pillars of quality that we look for. So when we string all these together, we can create a high level of confidence that whatever difficult situation that the company is going through, they will eventually be able to sort through it and get back to growth again. And when that happens, you will see the multiple compression go back to multiple expansion. And that's how we can unlock significant alpha. So again, rather than focusing on absolute price multiples, such as just picking stocks that are with a PE less than 15, for example, which is what a lot of value-oriented equity strategies do, we select companies that have endured substantial multiple compression to normalized earnings. Again, that is using the Shiller PE. This is a methodology created by Robert Shiller, professor of finance and economics at Yale University. I'm a big fan of his work. I've followed his work for several years now. I've read into his methodology and his theories behind it, and I think there's a lot of first principles thinking behind it, a lot of valid thinking behind it, academic thinking behind it, and so we are using that as a core bedrock of our deep value proxy that we're launching here today. This is also known as the cyclically adjusted PE, the CAPE ratio. This has an established track record of core quality characteristics, growth, ROIC, and free cash flow conversion. So again, if we combine all four of these together, a deep multiple compression according to Shiller PE, a long-term track record of compound growth, high ROIC, and free cash flow conversion, if we string all four of these together and then finally top it off with the fifth principle, which is qualitative analysis on whether they are an industry leader, and as long as they're not being disrupted by another company or another technology, these five together gives us high level of confidence that the companies that we're picking right now are true deep value opportunities and not a value trap, which is what most value-oriented equity strategies suffer. So here's a quick case study, Albemarle. Take a look at Albemarle. This is a company that's in our portfolio. Albemarle is the world's largest lithium producer. They produce lithium for applications in electric cars, battery storage systems, and consumer electronics. We all know the importance of lithium for battery production, but shares have been under severe pressure over the last 2 years. This is mainly because lithium prices have collapsed due to oversupply. The original estimates of electric vehicle adoption in North America were sharply lowered. So this led to oversupply of lithium. This forced the company to cut production, stall factories, cancel projects, book substantial one-time restructuring and asset write-down expenses. So again, not good, right? But remember, if everything is, if everything is roses and sweet-smelling gardens, shares never go on sale. So there always has to be a narrative. There always has to be some, rocking of the ship for high-quality businesses to go on sale. And Albemarle is a high-quality business because if we look at the evidence, they have a track record of consistently high ROIC. They have a high track record of long-term earnings growth, even if current earnings are negative on a year-over-year basis. Not negative in the absolute sense, but negative in terms of growth. They do have consistently high free cash flow conversion. They are an industry leader. They are the number one producer of lithium. And as long as we can say with confidence that lithium isn't going away, right? And as long as we can say with certain degree of confidence that electric cars will get back to growth, that large utility scale battery storage systems will be the norm, then we have some reasonable level of confidence that Albemarle can work through this rough patch that they're going through and eventually get back to earnings growth again. So, but those that are focused on traditional valuation multiples like PE, even if they use forward-looking estimates, would miss this opportunity and fail to buy the stock because it still looks expensive, despite the fact that shares are down 50% over the last year and a half. And here is a direct chart that compares the two. If you look at the top chart, that is the forward PE. And despite this drop in the stock price, the PE multiple has expanded. And it's actually at basically 30-year highs at a 47 multiple to this year's earnings. If you are a PE-oriented investor, you would be running away from this company, because this is actually seeing PE multiple expansion to a degree that we haven't seen ever in the history of Albemarle. Basically, it's at the highs over here in 2021. This is almost a 2 standard deviation move above the long-term average for Albemarle. So anyone that's using PE, anyone that's using a value-oriented approach, classically speaking, meaning more traditionally speaking, would not be buying shares of Albemarle. However, if you're focused on long-term earnings, meaning normalized earnings, meaning an average earnings base over, say, a 10-year period, which is what the Shiller PE does, look at the multiple compression. This is now trading at under 10 times average earnings over the last 10 years. And that matches basically an all-time low that we have seen repeatedly over the last 30 years. So this, in my view, just my opinion, could be wrong, but this is a multiple compression that we would love to buy, because this is a company, again, the number one lithium producer in the world. They produce an element that is at the crux of electric cars and battery storage. And if you're bearish on electric vehicle adoption and on battery storage adoption, we believe that Albemarle will eventually work through this rough patch. Again, they went through a rough patch because they overinvested in supply, and it turned out that electric vehicle adoption didn't go as fast as we thought it would. However, if you're focused on a 5+ year time horizon, which is what our strategy is, we believe that shares now are extremely attractive, because as long as they can get back to growth, as long as they can get back to trend, we will see not only earnings growth, but multiple expansion. And that is the twin engine of alpha. Earnings growth combined with multiple expansion. So we believe that this extreme pessimism in Albemarle shares right now is a buying opportunity, because most of the expectations, as you can see here, have now been squeezed out. So again, we can only see the value here if you are using normalized earnings rather than any given single year of earnings. Because again, this year earnings are artificially depressed as they work through a lot of these items that are one-time in nature. When you cut production, install factories, you run below capacity. When you cancel projects, you incur restructuring expenses and asset write-downs. But again, these are one-time expenses. Now, maybe they last for a year, maybe they last for a year and a half, maybe it lasts 2 years. But for those with a long time horizon, this is now the time to be buying shares of Albemarle. Not because of this year's earnings, but because if you have reasonable level of confidence that earnings can get back to long-term trend, it doesn't even have to be extreme growth. We don't need NVIDIA-style growth. We just need earnings to get back to long-term trend growth. And if that happens, then we would get the benefit of both earnings growth and multiple expansion of that earnings growth that leads to significant alpha over time. So again, Shiller uses normalized earnings. Again, if you were to define that, it is basically calculated based on a 10-year moving average of inflation-adjusted earnings per share rather than nominal earnings during any single year. So this methodology, this approach, that Robert Shiller came up with reveals the actual multiple shares trade at, since single-year financial results can and frequently are impacted by short-term effects. So if we can see past those short-term effects, and if we have a longer time horizon, then the Shiller PE can be very, very powerful at revealing true deep value opportunities. So we have to use a multiple on earnings that's beyond just a single year. Shiller uses 10 years. We also, in our analysis, can use a 5-year modified Shiller PE, maybe even a 3-year modified Shiller PE. So we do make exceptions. There are exceptions that we can make, and that's on a discretionary basis. But the principle remains the same. We look for companies that trade for an extreme multiple compression, meaning we look for companies that have endured extreme multiple compression to some normalized earnings base. And typically it's 10 years, but in certain cases, we can look as short as 3 to 5 years, to make these picks, because not all companies have had positive earnings for at least 10 years. Some companies may have had earnings being positive for maybe about 8 years. So there are cases where we will add companies to our deep value proxy that don't exactly have, a 10-year track record of earnings. But the principle remains the same. We look for companies that have endured significant multiple compression to some methodology or some calculation of normalized earnings. Most of them are on a 10-year basis, but I just wanted to say that some of them can be on a shorter time frame as well, to take advantage of drops of companies that don't have that long of a track record. But through our qualitative analysis, we can say with confidence that they check off each and every one of these 5 principles that govern our portfolio. Deep multiple compression to normalized earnings. Again, usually normalized earnings refers to 10 years, but it can refer to something as short as 3 years. Track record of consistently high ROIC. Again, we like 10 years, but can do it as short as 3 years as well. Track record of long-term earnings growth. Industry leader, consistently high free cash flow conversion. These are the general principles that we look for when deciding this portfolio. So what this ultimately ends up doing is we find, these high-quality companies that are trading at a deep discount to normalized earnings. We'll never usually get them. It's sometimes we will get them, on a low PE, low price to free cash flow basis. Sometimes that does happen, where we have high growth companies trading at a good PE multiple and a good free price to free cash flow multiple. But not always that is the case, such as in the case of Albemarle. So again, typically speaking, high quality companies don't usually trade at low PE multiples. They just don't. So the only time we can ever buy high quality companies at a discount to normalized earnings is when they are going through some rough patch, some difficulty, some short-term turbulence. Like I said, for Albemarle, it's because they overinvested in capacity. But again, we believe that is a transitory situation, and that once we cycle out of this environment of lower production, we will be able to get back to growth, and ultimately this multiple will expand once that sort of earnings trough is determined, and they can finally get back to growth after cycling out all of that noise that we saw here over the past 1.5 to 2 years. Again, these are the types of companies we try to focus on and run towards when traditional value-oriented strategies are running away from them, if they're focused on PE multiples. So these are some of our top ideas in our portfolio, the Zacks Deep Value Proxy. You can see these are just a couple of the companies that's in our portfolio. And we hope that this strategy of looking for companies that are high quality They, are great at what they do. They have a track record over time of generating very attractive returns on capital. They are companies that have proven an ability to compound capital over time, but are just going through something in the short run that's difficult. And shares now reflect that reality based on the multiple that these companies trade at to normalized earnings. So these companies right now offer very, very attractive entry points to them. And so the idea is that we buy them and hold them for for a long enough time frame for them to work through the difficulties that they're going through. But given the fact that a lot of these companies are trading at basically lows or very close to lows that they've ever traded at in history, throughout their own history, we have some level of confidence that the bottom is close. And so now is a great time to be dipping your toes into them. So again, our methodology is quite different from traditional value-oriented equity investing strategies. And we hope that this approach leads to substantial alpha over a long time frame. So again, our time frame when we make these investments is 5 years. So it's very long term, just like the Zacks Earning Certain proxy that we manage, where a lot of those companies that we add, we hold for many years. This is the same exact approach. We like to hold them for somewhere between 3 to 5 years, possibly even longer. But we believe that this approach will lead to substantial alpha over time. So would love to hear any feedback, any questions you have on this strategy or any of our other strategies, the Zacks Earning Certain proxy or the Zacks Deep Value proxy. Please do give us a call at 1-866-794-6065 or send us an email to strategycall@zackspro.com. Thanks, everybody.